Hey guys, welcome back to a brand new video. I'm RexFinance, and today we need to discuss this upcoming dip in the stock market. And yeah, you might realize or recognize I got some scratches on my arm here. I got into a fight with a bear, but I won it, so that could be good omen for the stock market. No, and also I was actually just cutting trees outside. Yeah, but this is serious today. I got on my red shirt. I turned the lights in the background to the color red, so we mean business. Right now, we are the fastest growing stock market YouTube channel. I don't know what you guys are doing, but keep doing it. I would love to continue this trend if we can, that'd be great. So if you're new here, returning and not yet subscribed, I'd appreciate hitting that subscribe button down below. But let's discuss this. Today, the Atlanta Fed came out with their new GDP Now forecast for Q3, and their forecast is for GDP to grow by basically 3.9% in quarter 3 of 2023. That is ridiculous growth for the economy. This will be revised and more than likely it'll go down, but still, this is a really good starting point for their initial forecast for Q3. And if any of this holds, it just kind of signals that we're going to sidestep this recession even more. In addition, this earnings season has been a spectacular one. The S&P 500 so far this earnings season has had a positive net revenue surprise. They beat analyst expectations by about 1.5% on revenues, and with earnings, it's even better. They've surpassed analyst expectations by about 7.3%. And this is actually something I've discussed on my channel in the past, where we're going to see this continue. Gross margins of companies and the profitability of companies is going to expand like crazy, while maybe revenue numbers and sales numbers really start to cool off or don't grow quite as fast. And that's a direct result of the cooling of inflation that we've seen. When inflation first picked up, it was the opposite, where the profitability and margin that companies had got squashed despite their revenue and sales numbers expanding super fast. The higher the profitability of these companies and the higher their gross margin is, obviously that's better for investors. So this is a really, really good catalyst for the stock market moving forward. This morning, we got a new JOLTS report, which basically just shows an overview of the labor market. This new JOLTS report showed signs that the labor market continues to cool, although it remains pretty solid so far. The amount of job openings still remains plentiful, but this has been downtrending all year. In June, the amount of job openings were down 34,000, which I have this written down in my notes, lucky for me. The total decrease in job openings year to date is now 1.65 million. This is another good thing for markets. We want to see the balance in the labor market be restored, and if job openings are coming back down while the labor market still remains relatively solid, that means good things for the stock market. But it doesn't even stop there. New construction data showed that construction, all sorts of construction, whether that be private sector or public sector, continued to set new record highs in the month of June. In the new data, they also revised May's numbers up, and specifically, public construction was up for the 12th time in 13 months. In the month of June, public construction was up by 14.8%. This is something that bears have completely ignored or completely forgotten about one way or the other, because fiscal stimulus remains very accommodative and supportive of the overall economy. Sure, right now monetary policy is restrictive, but that's only half of the equation. The fiscal policy in our country right now is still supporting growth in the economy, and we can see that via these public construction numbers. And we also got a new batch of manufacturing PMI this morning. If you're unfamiliar, PMI stands for Purchasing Managers Index. It basically covers the amount of new orders, the production that companies have, and different employment statistics as well. Manufacturing PMI has been below 50 since November, which is the longest streak since the great financial crisis of 2008 and 2009. This reflects this rolling recession notion that I've been talking about on this channel, where we've seen a rolling recession hit the goods sector, specifically for producers and distributors. This is all a result of consumers shifting their buying behaviors away from goods and more towards services. However, it appears that this rolling recession in the goods sector is going to turn into a rolling recovery, which is good for the economy, which is good for the stock market. It appears that manufacturing PMI bottomed around 45, and in the month of July, we upticked to 46.4. All of these things I covered are very positive things for the economy and the stock market. So why do I think a stock market dip's coming? It might not be as obvious to you guys as you think. There are a few different worries out there of maybe why we could trend back towards a recession. I personally think that this rolling recession is going to roll into commercial real estate, which could end up causing an economy-wide credit crunch, which could send us into a recession, which would obviously be negative for the stock market. Via the JOLTS report that we just got today, we can also see that the labor market remains tight, and we also have different labor unions pushing for higher wages. That could cause a renewed wage price spiral, which would be bad for inflation, which would cause the Fed to raise rates even higher. And the last risk that I really see here is the fact that the 10-year Treasury has now surpassed 4% again and continues to march higher. Rising bond yields will absolutely weigh on valuations of companies in the stock market, specifically the mega cap 8 that have spearheaded this entire stock market rally. But in my opinion, none of these reasons that I just listed out are likely to happen. I don't think any of these scenarios are going to play out. So I'm not even concerned about these different worries. What I'm concerned about is the shift in the market that we've seen. You see, last year in 2022, I was one of very few amount of people that was bullish on the economy, bullish on the stock market as a result of that. I even made a video calling the October bottom, and that was my most disliked video that I've ever made. And that's because people disagreed with my thesis. But the reason I really felt that that was going to be the bottom was because it felt like we were at peak fear, uncertainty, and doubt. So the risk of even worse news coming into the news stream was very low because most investors had priced in doom. But as this rally has gained steam, more and more investors are joining this camp. The camp that's saying we're actually going to see a soft landing and avoid a hard landing, or maybe have no landing at all and just have a rolling recovery from this rolling recession. That's personally my thesis at this point. The amount of people that actually believe a hard landing is still likely has been diminishing like crazy over the past few months because you can't ignore the data that's come out. The economy remains strong. Inflation continues to come down, which all points to a soft landing. And as a result of more and more believers joining the stock market, that means more and more good is being priced into the stock market. Now, this is absolutely when we as investors make the most money. It's when all of the bears start to shift to the bullish side, but it's also when we need to prepare for corrections. It's really the direct opposite scenario of what we saw in October of 2022. Right now, good or even great is being assumed by investors. When that's the case, it is much easier for investors to be disappointed when bad news comes out, or when even less good news comes out. In October of 2022, because investors had priced in so much downside, it wasn't that difficult to see headlines come in as good or better than expectations or even less bad, which results in the stock market going up. Now, do I know when this stock market dip or correction is going to take place? Absolutely not. I'm not going to sell out of my investments despite me being up almost 100% this year in 2023. Absolutely not. I believe the companies that I own in my portfolio are still tremendously undervalued. In fact, I even went out and bought shares of a new company today. I've started my position in Enphase Energy. There still remains a lot of opportunity in the stock market. Most stocks this year are up 20 to 30 to 40 to even 60 or 70% depending on the company. But Enphase Energy is down 41%. Do I know when Enphase Energy is going to reverse? Absolutely not. But if we do get a market correction or a market dip, worst case scenario, maybe even best case scenario, I get to buy more shares of this company for an even cheaper valuation. If you want access into the stocks I'm buying, join the membership down below. It's the cheapest one on YouTube. You won't regret it. If you do, I'll refund you. But this dip or correction could come after we hit new all-time highs. It could be right now. Or it could be next week or next month. I really don't know. I just know that eventually the markets are going to take a breath, which is a very, very healthy thing. Specifically, I'm really hoping that we see large caps, and in particular, the mega cap 8, which includes Amazon, Tesla, Nvidia, Apple, all of those companies, Microsoft, etc. I hope those companies cool off a little bit. Their valuations are getting a little bit extended. Now, yes, their forward earnings are coming up because analysts are revising their expectations, which is a good thing, which will bring their forward PE valuations down, but they're still overextended according to historical records. Small cap and mid cap companies still remain undervalued according to their historical records, which is why most of my portfolio is positioned into these sorts of companies currently. I made a video discussing my current portfolio strategy where I'm trying to build my cash position and I've slowed down my buying because of my thoughts here. If you want to go check that out, I'll make it easy. Hit the I in the top right hand corner. Again, if you're new here or returning and not yet subscribed, I would greatly appreciate hitting that subscribe button down below. Leave a like and a comment if you feel so inclined. I like seeing all the new faces, even though I can't see your faces. It's just a profile picture. I like hearing from you guys, so be sure to share your thoughts down below. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.